Welcome back. So I hope you've thought long and hard about the 4 possible answers to the question on market capitulation. And funnily enough, this one doesn't have one single correct answer. Sometimes it's better to wait and watch in the markets, which means the option C would be relevant, because often markets take a long time to come out of a bear phase. And at other times, some amount of bottom fishing, that is option D, may not be a bad idea. One thing is for sure, that capitulation is very hard to predict, and you have to hedge your bets in a market like that. That would be a fair assessment, right, Doc?
Yeah, I had shown you this earlier with MACD as well as RSI, but I would also like to highlight one more indicator here which is pretty useful to find the end of trends, and that is something called the ADX, also known as the DMI in some softwares. And here on the chart I have shown you the ADX. Now ADX is a little tricky and slightly different from the others, but an ADX with a rising trend is what we got to see it, and a rising ADX is what really tracks a strong trend on the downside. Now, once the trend is over, the ADX will actually end its advance, and that is an extremely reliable signal that the trend in progress is certainly over. Now you have this fast and furious decline which has been well tracked by the ADX right from its initiation and right down to its end, and see when the market actually forms a higher bottom, that's where the ADX actually turns down. So the ADX is a superb indicator to find out when the end of trends happen. So along with MACD RSI, I would strongly suggest that we should be taking a look at ADX as well. And
it's, just before that blue arrow, you see the ADX actually showing like a little mountain formation. It goes up and it goes down. What does that indicate?
Actually, the rising ADX is the key thing. The rising ADX is what is tracking this part of the falling trend. We spoke about two sets of decline.
Yeah.
This is the first set of decline which is being tracked by the ADX. As soon as the decline gets over, the ADX will halt its uptrend, and then when the decline starts again, the ADX again starts. So ADX is a little bit different from all the other indicators, so you need to know a little more. We'll probably speak about it in future episodes.
Okay, so that was an interesting analysis on ADX, and while we're on the topic of market bottoms, we all know that it's common knowledge that most stocks will actually follow the downward trend in a weak market. So say 7 out of 10 stocks will really decline when markets are bearish. But to get a sense of how to trade these markets, let's quickly see how technically strong stocks and essentially good stocks behave in these weak markets. And there's a table that will come up for you on your screen that will show it. So essentially you can see that if the market trend is down, you will see that good and solid stocks generally tend to be either sideways in movement, or they will actually show an upward price movement. Momentum will definitely be on the higher side. It is possible that every price rise will be accompanied by weak volumes because there are fewer buyers in the market, but essentially bullish candlesticks will also be seen. So this is how strong stocks behave in bearish markets. How would you trade these then, Doc?
The first of the things is actually to find out which these set of stocks are. So we'll have to set up some sort of a query module which says that a certain set of stocks are actually outperforming the index. The index is going on one side and these stocks are going up. It'll be difficult to find them because you won't find far too many in number, right? Markets generally, when they are going down, total number of stocks which are going up against the trend, which will be fewer. So you'll have to try and find them. Second thing is not more of how to trade them, it's more of what sort of expectation to have. You cannot really expect a stock to go up 100% when the rest of the market is going down. So we'll have to tone down our expectations. We'll have to tone down the total amount of exposure that we take. We'll have to slow down the kind of approach, because there will be a series of dips.
If you have to put aside 100 rupees,
you probably do it in phases. Like you asked in that particular quiz, right? We are going to have a little bit. Let's say put in now, a little bit later. We'll use the dips in the market to actually scale in the buying during such phases.
So you would still go out and buy?
Yeah, because the stocks are clearly doing much better than the index, so they have something worthwhile which makes them do better. So when the good times are back, these will actually flourish.
Right, so that is so much for the strong stocks. Technically, weak stocks, as we would have all imagined and guessed, actually do much worse than the index on the downside. And especially mid-cap stocks, we've already seen in many of the past cycles, seen as much as 80 to 90% erosion in weak markets. How would you trade these, Doc? You'd obviously go short.
See, the mid-caps are very typical. In an uptrend, they actually do much better. And in the later stages, of course, and in the downtrend, they do much worse than the index. Now, if you look at this chart, I have actually had it mentioned here. This is from the May low of last year, 2010, to the November high. you actually had a 36% run in the mid caps in about 120 sessions, compared to only 32% rise for the Sensex. So during a rise, the mid cap actually do well towards the later part of the trend, right? But when the trend changed and the market went down, you had the mid caps falling about 29% in this fall, compared to only 18%. So the mid cap in the fall, they actually do much worse. So you have to be very, very careful. Even during the the time the market came back, the mid caps actually came back only 43%, compared to almost 66% recovery in the terms of the Sensex. So the mid cap, you have to be extremely careful. When the market uptrend gets over, just get out of the mid caps. Don't hesitate. Don't try to bring in any kind of logic to hold on to the stock. They do much worse when the market turns down, right?
So even at the risk of losing a little bit of your upside,
yes,
if you
must
feel the market has turned,
yes.
just sell all your...
Just move on, because they do much worse on the downside.
And even if you see them falling sharply, don't be tempted to go back into them.
Not at all, because you don't know, because the subsequent recovery will also be fairly tepid, unless the market trend itself has changed.
Okay, time for a short break. We'll come back and set up some trade ideas for you in these kind of technically weak markets.